Support and resistance. They are key levels that uses historical data to predict where prices might reverse. If the price is below the level, it's called resistance, and if the price is above the level, it's called support. To find these levels, identify areas where prices has bounced off multiple times, then draw a straight line across them. Enter your position only after the rebound has been confirmed. Here's another example for bearish condition. Just a quick clarification, short means betting that the price will go down and you do not own the stock. It's different from selling where you already own the stock and want to take profit. Breakout patterns is when the price makes a strong move towards one direction, typically after a consolidation phase. For example, here you can see that the price is consolidating and then it suddenly moves towards the upside. This is called a breakout. To take advantage of this, here are some notable breakout patterns that can help you make profitable trades before they happen. Rectangle, pennant, triangle, flag. Reversal patterns. They are chart patterns that signal a potential change in current trend direction. For example, here you can see that the price touches the peak twice before reversing back down, suggesting a potential trend shift. To trade reversal patterns, start by identifying the neckline. Measure the height between the peak and the neckline and project the height downwards. Enter your short position just below the neckline once the price confirms the downtrend. Then exit your trade at the projected target near the bottom. To take advantage of this, here are some common reversal patterns to help you predict price movements before they happen. Head and shoulders, inverse head and shoulders, double top, and double bottom. Candlestick patterns. Each candlestick shows 4 key pieces of information: the opening price, the closing price, the high, and the low for a specific time frame. Here are some notable candlestick patterns you should know. A Marubozu indicates strong momentum in the candle's direction, categorized by a long body and minimum or no wicks. This suggests intense buying or selling pressure, and is particularly significant during breakouts. A shooting star features a small body and a long upper wick, signaling price rejection at the peak and leading to a downtrend. Red shooting stars typically indicate stronger reversal than green ones. A hammer features a small body and a long lower wick, suggesting that buyers are regaining control, potentially leading to an uptrend. Green hammers generally carry a higher likelihood of upside than red ones. Finally, a doji, categorized by a very small body, reflecting market indecision. When you spot a doji, it's crucial to monitor the next candle for confirmation of the trend's direction. Heikin Ashi. It means average bar in Japanese and is used to make trends more visible by smoothing out price action. To use it, simply click on the candlestick icon at the top bar of your chart and select Heikin Ashi. When all the candles are green, it indicates a bullish trend, while all red candles signals a bearish trend. To trade Heikin Ashi, look for a doji candle followed by 2 candles in the opposite direction to confirm the reversal. For example, here we see a doji candle at the peak followed by 2 red candles. This is your cue to enter a short position on the 3rd candle. Similarly, at the bottom, we see a doji candle followed by 2 green candles. Enter a buy position on the 3rd candle. The same principle applies to here and here. On-balance volume. OBV is a momentum indicator that uses volume to predict changes in stock price. Simply put, OBV reflects supply and demand. Rising OBV signals increased demand, meaning more buyers are entering the market, pushing prices up, while falling OBV shows increased supply, meaning more sellers are in control, pushing prices down. To trade using OBV, focus on the direction of OBV relative to the stock price movement. For example, here we see OBV falling and rising alongside price. Now, here's the key. Watch out for divergence. Connect 2 low points of the stock price and 2 low points of the OBV. Notice how the directions of the 2 lines differ. This divergence reveals hidden buying pressure, signaling a likely uptrend ahead. And that's it for today. Should I do a part 2? Let me know in the comments below. If you found this video helpful, make sure to like and subscribe. Thanks for watching and see you in the next video.